The conflict between China and the United States of America is entering a new phase. This time, the blow has been dealt to the global energy market. In March of 2025, China unexpectedly halted imports of liquefied natural gas, LNG, from the U.S. worth $2.4 billion annually. This decision shocked energy players worldwide and was seen as a direct retaliatory measure against the 10% tariffs imposed by Washington on Chinese goods. Amid this trade escalation, China instantly redirected LNG supply routes to Europe, a region desperately seeking alternatives to Russian gas. The U.S., which considered itself the leading player in this market, suddenly found itself sidelined, watching as billions of dollars shifted to other suppliers. Germany, the Netherlands, and Italy, key EU countries, quickly altered their import policies, launching large-scale projects to build gas storage facilities, modernize port infrastructure, and expand energy logistics within the bloc. Europe welcomed Chinese LNG with open arms, while the U.S. lost an important channel of influence. At the same time, Australia, almost unnoticed by the wider public, signed its largest energy contract with the Chinese giant China Resources Gas. The value of the deal, $1.5 billion. The term 15 years, the volume 600,000 tons of LNG annually starting in 2027. Australian gas proved not only 20% cheaper, but also 10 days faster in delivery due to geographic proximity. Thus, Australia, long considered a U.S. ally, is now becoming a strategic partner of Beijing in the energy sector. This is not a one-time course correction. Since 2019, China has been systematically reducing the share of American gas in its energy mix, bringing it down to 5.4% by 2024 compared to nearly 20% previously. In return, Beijing signed long-term agreements with Qatar, Russia, Central Asian countries, and strengthened strategic cooperation with Australia, not only in LNG, but also in the field of critical minerals. The result? Frozen contracts, idle LNG terminals in the United States, a sharp rise in logistical costs, and panic among traders. America, which only yesterday dominated the energy front, is now losing market share and being forced to watch as its place is taken by Australia and other Asian partners of China. Amid this blow to the American LNG sector, Washington faces another setback. In March of 2025, Canada signed an agreement with Beijing to increase oil exports through the expanded Trans Mountain Pipeline, raising its capacity from 300,000 to 890,000 barrels per day. Half of Canada's crude now goes to China, pushing out American suppliers. Moreover, the LNG Canada project, one of the largest LNG facilities in North America, comes online in the same year. Its capacity of 14 to 26 million tons annually is a direct challenge to the United States. But that's not all. China has also begun drastically reducing imports of American agricultural products. Soybeans, a key U.S. export, have taken the hardest hit. In 2016, the U.S. accounted for 40% of China's soybean imports. By 2024, it had dropped to just 18%. The main suppliers are now Brazil and Argentina. Meanwhile, wheat, corn, and cotton are now actively exported to China by European and South American companies. The blow to American pork producers has been especially severe. China sharply increased meat imports from Spain and the Netherlands, while shipments from the U.S. collapsed amid high tariffs and intensified inspections by Chinese authorities. In 2023, pork exports from the EU to China grew by 35%, while U.S. exports declined. For American farmers, this is a catastrophe. Overproduction, falling prices, and financial losses. Small farms are suffering the most, lacking the resources to adapt quickly or access alternative markets. American industry is also feeling the consequences. China is reducing its investments in U.S. tech companies such as Tesla, Intel, and Google. Beijing is actively shifting its cooperation toward Canada, Europe, and BRICS countries. In the long term, this threatens the United States with a gradual decline in global influence. Meanwhile, Washington continues to pump up the defense budget. Amid economic upheaval, President Trump introduced the new F-47 fighter jet project, which is intended to replace the F-35. The cost of the program is tens of billions of dollars, while millions of citizens are facing cuts to social spending and rising prices. The public is increasingly asking, why invest in defense projects when internal stability is collapsing? Trump's statements suggesting that Canada should become the 51st U.S. state are causing confusion even among allies. Against this backdrop, Ottawa is strengthening military cooperation with Europe, Australia, and countries in the Asia-Pacific region. Canada is becoming an increasingly independent player, aiming to protect its strategic interests in a time of global instability. The culmination is a shocking statement by the U.S. President about the possible accession to the Commonwealth of Nations under the leadership of King Charles. Though this political move may sound provocative, it reflects the disillusionment of the American elite with the current course and an attempt to reconsider the country's global position. Amid rising deportations, economic instability, escalating trade wars, and the political rhetoric of the Trump era, it is becoming clear. The United States stands on the threshold of a systemic crisis. Public opinion is increasingly leaning toward the belief that what is needed is not just a new leader, but a radical shift in strategy. While China builds coalitions and gains access to new markets, America is losing ground, losing partners, and possibly losing its global future.